Hello, and thank you for joining us for the webinar. It's my pleasure to introduce today's speakers, who are all members of Anchin's COVID-19 resource team. Joining us today is Greg Wank, partner and leader of Anchin's Food and Beverage Group, Anthony Bracco, partner and leader of Anchin's Litigation, Forensic, and Valuation Services Group, and David Beckman, a director in Anchin's Litigation, Forensic, and Valuation Services Group. In addition to this session, Anchin has put together a COVID-19 update center housing the latest information on impacts and opportunities related to the outbreak. You can find that at anchin.com. We have muted all attendees, but we welcome live questions and insight from you during the program via the questions box in the Zoom platform at any time. Today's slides were emailed to you in the reminder email and will be resent along with the webinar recording after the session. If you encounter any issues throughout the presentation, please notify us via the Q&A function in Zoom or email us directly at events@anchin.com. It's my pleasure to now turn this over to Greg, Anthony, and David.
Thank you, Ashley. Good morning, everybody. Thank you for joining us. We're going to go through a lot of the materials that have become available in the last week or two about loan forgiveness. We're going to go through updated guidance, clarification. There's still a whole bunch of open issues and open questions. We're going to outline those for you pretty early in the presentation so that you understand that some of the guidance we provide is still based upon assumption and based on the reads of different aspects, but there's no clear black and white answer on some of these things yet. We'll review the key terms and definitions based on the updates. We're going to go through the actual forgiveness applications. We have a revised Form 3508 and a brand new 3508 EZ form, and we'll talk about which one you use in which case. And we'll certainly promise to leave time for Q&A at the end. Next slide, please. So just a brief overview of how we got to where we are right now. We have the initial loan forgiveness application that was released May 15th. And then June 5th, about 3 weeks later, the Paycheck Protection Program Flexibility Act, PPPFA, signed into law, which dramatically changed the requirements for forgiveness, in most respects, making them easier. So therefore, starting on June 16th, the SBA issued a revised form and created the new EZ form, and we'll go through those. And then just as recently as last week, we have completely revised IFR related to PPP forgiveness that came out from the SBA and the Treasury Department. And we've gone through that in detail, and we're going to go through what those clarifications are and how they're going to impact your forgiveness process. Next slide, please. So the key difference between the EZ and the non-EZ is that the backup schedules that are required to apply all the different adjustments for salary reductions and FTE reductions don't exist on the EZ application. So therefore, it's only 1 page of calculations as opposed to 3 pages. And we'll talk about who gets to use the EZ form. The covered period, as everyone I'm sure by now is aware, was extended to 24 weeks. However, borrowers who had their loans before June 5th may still elect to use an 8-week period. We had clarification last week that borrowers can elect to file their application for forgiveness before the end of their covered period. So if you choose the 24-week period, you don't have to wait 24 weeks to apply for your forgiveness, and we'll get into that as well. And of course, the other headline reduction was the 75% threshold for payroll costs was reduced to 60%. Next slide, please. And we also have new safe harbors, so that they've created several safe harbors to the FTE test, and they had to change them because of the Flexibility Act. So we had the June 30th safe harbor date where even if you had FTE reductions and wage reductions during the period, if you had restored them by June 30th, you would not have to suffer those reductions. That June 30th was changed to December 31st, or the date the forgiveness application is submitted. although there is an exception on the 25% salary reduction test, which we'll get to a little later. Obviously, they also increased the loan term. So if you apply for your PPP loan on or after June 5th, you have a 5-year term as opposed to a 2-year term. However, everything in the Flexibility Act was trying to make it easier for you to get forgiveness. So hopefully most companies won't have a loan to repay at the end of their 24-week period. That's the desire of Congress when they passed the act. They clarified the loan deferral period. So if you do have an unforgiven loan, you have until the time that you receive, or that your lender receives from the SBA, the amount of your loan that's forgiven before you have to start making payments. However, even if you never apply for forgiveness, you still have 10 months of deferral before you'd have to start paying back your PPP loan. Next slide, please. And they created another exemption from the FTE test. Basically, that if you tried but were unable to rehire your employees who were there as of February 15th, couldn't find alternatives to replace them, or your business didn't allow you to hire them back due to COVID-related matters, due to regulations and guidelines that were issued by Health and Human Services, the CDC or OSHA during the crisis, that would also be an exemption from the FTE reduction. So this is welcome news to many businesses who suffered and still can't open full and don't need all their people back because of those reasons. Next slide, please.
Hey, Greg, just on that last point you made,
Sure.
Some people had asked prior to our webinar whether those had to be federally mandated rules or if it's state and local governmental guidelines, such as New York, New Jersey, or whatever state you happen to be in, or even city. And the rules in one of the IFRs, it explicitly states that you refer to your state and local guidance in terms of what businesses are essential or non-essential. And if your state or local government cause you to close down, then that falls under that prior rule we just discussed as it relates to filing for the EZ form.
Thank you.
Yeah.
And lastly, just on the overview of the updates, as I mentioned, the borrower may submit their application for forgiveness anytime before the maturity of the loan, including before the end of the covered period, if the borrower has used all the loan proceeds for which the borrower is requesting forgiveness. Now that being said, we are not aware of any banks right now that are accepting loan forgiveness applications. And we'll get into that a little bit later as well. But, looking at some of the larger banks, even most are saying at the earliest mid-July that they'll be ready. So at least 2 weeks from now, if not longer, before their systems will be ready to accept your applications. And this is that caveat I mentioned about the 25% wage reduction. If you do apply before the end of your period, and you had a reduction in excess of 25% of any employee's salaries, you are going to have to extend that through the rest of the covered period. So there won't be a safe harbor to get out of that, basically. So, if you are going to be an early applier for forgiveness, you have to take into account that if you've had this reduction in pay, you are going to suffer that reduction on that end of it. And that concludes the summary of the overview of the updates. I'm going to hand it over to Anthony to start laying out some of the issues that we're still dealing with and grappling with when it comes to forgiveness.
Thanks, Greg. Greg mentioned there are still a number of issues that have not been clarified, and also some information that's been inconsistent from the SBA and Treasury, which is creating some challenges in determining how to handle certain aspects of the loan forgiveness application. The first one is that based on the PPP guidance, when you calculate eligible payroll costs, The question is the payroll paid at the beginning of the covered period fully eligible, even if it includes days that were incurred prior to the covered period? So if your first payroll that you pay after receiving the loan proceeds, it covers a week of payroll prior to the covered period, can you include that? When you read the fact that it says you can include what was paid, you would think so. It's interesting though, because at the guidance does specify at the end of the covered period that you only include what was incurred during that period. So if you pay something subsequent to the end of the covered period, you would only include what was incurred. And this, you have to think about this when you're also considering the covered versus the alternative period. The alternative period starts on the first day of the first payroll or the first pay period after you receive your loan proceeds and ends at the end of the covered period. So if your covered period, if your period is 24 weeks, then using the alternative period, you're only going to get exactly 24 weeks of payroll costs in there. And we're asking the question, if I use the regular covered period rather than the alternative, can I actually potentially capture additional days of payroll costs? Now, that may not be an issue if you're using 24 weeks as your period, because you've borrowed based on 2.5 months of payroll costs, and depending on the impact of COVID on your business, with it, you may end up spending those loan proceeds on payroll costs well ahead of the end of the 24-week period. So it may be a non-issue. Do non-cash compensation payroll costs, retirement benefits, and health insurance incurred during the covered period qualify for loan forgiveness if you pay them subsequent to the covered period? Well, again, you would think that's a simple question because on the form, it'll reference those expenses as paid or incurred. On Schedule A of the long form, it asks for those expenses that were paid or incurred. But then if you look at the instructions for that Schedule A, when it talks about the non-cash compensation, it says to include the items that were paid. And you have the same issue on the EZ form, a similar issue, where they talk about cash compensation, wages, salaries, etc., and they say to list what was paid or incurred. And then when they break it out to the non-cash items, they say to list what was paid. So there's a little bit of confusion. There's inconsistency in the language, which is causing this confusion. And so we couldn't look, looking at the contradicting information, we could not say with certainty which one is correct. The other question that's come up is, for employees, can I fund retirement contributions in excess of the amount that I've incurred during the covered period? So can I pay more, maybe pay my entire 2020 contribution now and say it was paid during the covered period? That remains unclear. And adding to that confusion is the guidance for the EZ form, where it actually says, in particular for owner employees, to cap the retirement contribution at 2.5 months of their 2019 contribution. So it's, again, there's just a lack of clarity that's causing some confusion here. Another question is, if I restore my FTEs by December 31st, or the date that I file my loan forgiveness application, can I terminate employees subsequently without any sort of negative impact on my loan forgiveness? The way it is written now, and we haven't seen anything that says you could not do that. We don't know if the SBA has the ability to look at subsequent periods. We do not see anything that says they can. So at the moment, from what we're seeing, they cannot. But this is a question that a lot of people have been asking us. Next slide, please. There's a new cap on payroll costs for if you have a 24-week covered period. the new cap is $46,154 per employee. So if I file my loan application, my loan forgiveness application, let's say at week 14, is the cap lowered to 14 weeks at $100,000 cap? Logically speaking, you would assume so. There's nothing in the instructions or guidance that say so. There are no rules that prohibit the borrower from prepaying rent or utilities during the covered period and deeming these as eligible non-payroll costs. But there's an explicit rule that says you may not prepay mortgage interest. So we're not clear whether or not the SBA will reject an application that includes prepayments of rent or utilities. Will they disallow those costs? Because there's just an inconsistency in the way they're treating certain items. For borrowers that have an FTE reduction quotient of less than 100%, this is an interesting one. Can the borrower list qualified expenditures during the covered period that total more than the PPP loan amount to offset the reduction that they're going to incur for a reduction in FTEs? So, for example, if I had, under normal conditions, if I had a 10% reduction in FTEs and I just list my qualified expenditures up to my loan amount, then I take a 10% reduction, I'm only getting forgiveness on 90% of my loan. The question that's unclear is, now that I have 24 weeks, can I include, I may be able to spend way more than my loan amount on payroll costs, which are a qualified expenditure. Could I spend, for example, 200% of the amount of the loan on payroll costs? And then when I do the calculation, I reduce that by 10%, and I'm at 180% of the loan amount, and then I'm just limited to 100% forgiveness of my loan amount. So in other words, can I spend more than the loan proceeds to make up for that FTE reduction? And it's unclear. If you follow the letter of the form and follow it step by step, it does not prohibit you from doing that. But we don't know when you submit that application if the lender or the SBA are going to look at it differently. What specific items qualify as utilities? We're still unclear. They list specific items in the Act and in the guidance. One item they don't include is oil. So what if I use heating oil or oil in as a utility? Does it qualify? It's not specifically listed. So another lack of clarity. Is there an appeals process for borrowers whose applications for forgiveness were approved by the lender but denied by the SBA? We know that if the lender denies the application for forgiveness, the borrower can go back to them and provide additional information. There's a process, but the guidance provides no process if the SBA, if the lender approves it, forwards it on to the SBA, and then the SBA subsequently denies that application. So a lot of issues that lack clarity. Hopefully we'll get more clarification as the loan forgiveness applications get submitted and reviewed by the SBA. Now I'm going to turn it over to Dave.
Thank you, Anthony. So I know some people are submitting questions as we're going, and we intend to finish and have at least, hopefully, 15 minutes or so to try to respond to the questions that were received either yesterday and the day before or as this seminar is unfolding. So please be patient. Hopefully, some of the questions that you do have will be answered as we speak, and if not, we'll try to get to them at the end of the seminar. Next slide, please. All right, so I think by now most people have heard the term covered period and alternative payroll covered period. The new law instituted a 24-week period as opposed to the original 8-week period. As Greg mentioned earlier, and worth repeating, for those who took out a PPP loan prior to June 5th, you can still elect the 8-week period. For those after, it's a 24-week period, although if you think about it, if you meet your 100% loan use or use of the proceeds through the costs, you can do lower than 24 weeks anyway, which will affect the overall calculation, will affect your FTE calculations if you have to do so. Next slide, please. The alternative payroll covered period, and we'll call it the alternative period for short, just for ease of discussion. This has to do with when you start your calculation of costs. The covered period starts when you get the loan, the day you get the loan proceeds, and as Anthony mentioned, the alternative period starts on the first day during the covered period that the first pay period begins, so that you don't have to worry about truncating or adjusting that amount. Whether you're using 8-week or 24-week periods or something in between, the concept of covered period and alternative period do not change other than the length of the period. It's the start date that really is affected. Next slide, please. If you happen to choose the alternative period, you need to apply that to any payroll-related costs, whether it's wages, which are cash compensation, or what is referred to as non-cash compensation, which includes retirement, health, and state and local taxes. You must apply the alternative or covered period consistently in whatever calculation you do, which includes your FTE calculations. You cannot apply the alternative method if you choose that to non-payroll costs. Regardless of which period you choose, you still must apply the covered period to non-payroll costs, which are mortgage interest, utilities, and rent. Next slide, please. All right, so what are payroll costs? It's, again, cash and non-cash compensation. The cash comp includes salaries, wages, tips, leave, allowance for dismissal or separation, severance pay, and there are caps. If you're an employee and you're not an owner employee, if you use the 8-week period, you're capped at $15,385. If you use the 24-week period, your max comp is $46,154. Keep in mind, and there's nothing in the SBA guidance that addresses this, but if you do the 24-week period, both ultimately file early because you accumulate enough costs, will that cap be limited to the number of weeks that you apply? It's rational and reasonable to think so, but there is no specific guidance as to that. Hopefully, if you can file early, you're not digging further than what your pro rata payroll would be for each employee anyway, but just want to put that out there. Payroll costs, still on the same slide, please. Thanks. There's the paid and incurred issue, which Anthony addressed earlier. And you do have at the end of the period, if it's incurred through the end of your covered period, but paid, as long as it's paid after the covered period, but before or during the next regular pay date, you can include those costs as well. Okay, next slide. Thank you. About a month ago, there was some additional guidance as to payments for if you furloughed an employee and paid them, as well as hazard pay and bonuses. Those are all eligible if they're paid during the covered period. There is no limit other than what we discussed earlier. If it's the 8 weeks, the 15,385 number, or the 24 weeks, the 46,154. There are separate limits for owner employees, which we'll get to in the next slide or two. To the extent you're trying to figure out the number of hours as it relates to FTEs for employees that were paid either through furlough or theoretically, I guess, through severance, you would include their hours that they typically will work for the amount that they're being paid. So you would not ignore the fact that they're not working. You still include hours for them for FTE purposes. Next slide, please. All right, so here's our first glimpse at a form. At our last webinar, we went through form by form and we gave a case study and we filled in a bunch of numbers. We're not going to go into that level of detail, but we are going to address certain forms and point certain things out. For those who are not completely familiar with the Form 3508, there are basically three forms. There's the lead schedule, there's the PPP Schedule A, which accumulates all the payroll costs and FTE numbers. And then there's a detailed schedule, this one, the PPP Schedule A worksheet. There's a Table 1 and there's a Table 2. The main distinction between 1 and 2 is Table 1 is for those employees who made 100,000 or less in 19. And because of that, you need to track any reduction to their salary, and that's that 25% or more rule. So employees who made less than 100,000 or less in 19, you need to track that. If you go to the next slide, table 2, that's for employees that made more than 100,000, and because of the rules, you do not have to track any reduction to their salary. So if an employee made 200,000 in 19 and you lowered their salary to 1,000 during the covered period, there is no reduction. 25% rule, you might have difficulty meeting the total covered costs in that situation, but there is no extra reduction for that 25%. And these amounts, what these forms will look like for each of the individual lenders could vary, but the general information of accumulating cash compensation during your covered period, calculating your average FTEs, and also calculating the 25% reduction rule will apply throughout. Next slide, please. Okay, compensation to owners. There is further guidance that hopefully clarifies some questions that we've had since the PPP Act was or PPP loans were initially enacted. Compensation to owners includes comp to C Corp and S Corps, otherwise collectively known as owner employees, comp paid to self-employed, sole proprietorships, and also general partners. The limitations for the comp that you can deduct is the same pretty much across the board, and we'll get into the nuances on the next slide. But if you choose a 24-week period, you're capped in the covered period for $20,833 per owner, and for the 8-week period, you're capped at $15,385. Now, you still have to pay those amounts. If you pay less than that during your covered period, that's going to be your max. And you're also, if your 2019 comp was less than 100,000, you need to go through that calculation of multiplying their comp in the 2019 period times either 2.5 months divided by 12 for 24 weeks, or 8 weeks divided by 52 times their 2019 comp, because you'll be capped out at their 2019 comp as well. Now, I know a number of folks have been asking, what are the definitions or specificity of ownership percentages for C Corps and S Corps, and the SBA has not issued any guidance on that. So it's up to your judgment. If, granted, you have typically 500 or less employees, so the odds of an employee owning an infinitesimal percentage may not be that high, but if it's true, if someone owns 0.0001%, you still consider them an owner employee. We can't make that call. That's really your judgment call. And whether you want to talk to your lender about that for further guidance, we suggest doing so. Next slide, please. Okay, so a little more guidance. C Corp, owner employees, they're capped by the 2019 employee cash comp. And the rules say and employer retirement and healthcare contributions, which differentiates from an S Corp, which is their 2019 comp and employer retirement, although it does not include health insurance. There's some confusion as to whether healthcare and employer retirement are included as a part of their overall cap or not. Based on the way the rules were written in the instructions of Form 3508, it's fairly clear to us that for a C Corp employee owner, you would include their comp as one number, and whatever is paid on their behalf for retirement and health care would be included with the other employees on whatever lines are included on the Schedule A. So they're not grouped together as one cap, they're separated out. S Corps are a little bit different in that you include their comp separately, and employer retirement you also pick up, but you ignore any contributions for health insurance. For self-employed employee owners and general partners, they're capped at just their compensation. So you don't get any additional benefit or deduction for any contributions made for their retirement or health insurance. And the general partners have a little bit more involved in their calculation by starting with their earnings, making certain deductions, and then multiplying it by 0.9235. Next slide, please. And these are the instructions I was referring to earlier. If you focus in on line 6 and look at the last sentence in line 6, this is referring to health insurance. It says, do not add employer health insurance contributions made on behalf of self-employed, general partners, or S Corp owners. It doesn't talk about C Corps. C Corps are not excluded from this deduction, any health insurance paid for them. For line 7, again, the last sentence, do not add employer retirement contributions made on behalf of the self-employed individual or general partner. Again, or not again, but a little bit different, both S Corp and C Corps, any employer contributions for retirement plans should be included in line 7 because they are not explicitly excluded here. Next slide, please. And I think I'm handing this off to Greg.
Yes, thank you, David. I was monitoring the questions during your presentation. There's still a lot of questions about LLC members and a lot of questions about guaranteed payments that they're confused. I think we just got to clarify for everybody. It doesn't matter how you pay a general partner in a partnership. That includes an active member in an LLC. It doesn't matter. It's based on the self-employment income, which includes guaranteed payments if you do pay them guaranteed payments. But that's not the relevant number, right? The relevant number is what is their SE income going to be from this partnership? And that's what's subject to the cap that David just described. Because there's probably a half a dozen questions about that. So I just wanted to clarify that for everybody.
And Greg, I do want to point out, especially for any sole proprietor, to the extent they want to take a deduction, they should physically cut themselves a check in order to prove that a payment was made during the covered period. Otherwise, there's no trail to any payment. Without the payment, you can't get the deduction.
For a Schedule C?
Yep.
Yeah. Okay. Okay, so I'm going to just go over a few things here related to the non-wages portion of payroll costs. A lot of questions about this, so hopefully we're answering them going through these slides. So what they've done is they've separated employee benefits versus owner-employee benefits. So employee health insurance, which would include all employer contributions to a health plan, are eligible. It excludes the contribution that's funded by the employee out of their pay. And it excludes contributions made on behalf of all the people David just talked about, self-employeds, general partners, owner employees. The exception here, the exception to the exception is it includes contributions for owner employees of a C corporation. So, that only took us a couple of dozen hours to read this 1,700 times to figure that out, but that's exactly what they're talking about in the revised regulations. So they are carving out a non-pass-through owner separately and allowing their health insurance to be added in full. Employee retirement plans, again, are eligible other than contributions made by the employee themselves. So obviously their own contribution to a 401k, that's not your expense, as well as any contribution you make on behalf of partners in a partnership or an LLC or a self-employed individual. However, it includes contributions made for owner employees of C Corps and S Corps. Okay. And last on this slide, employer, this hasn't changed. Employers' portion of state and local taxes, such as state unemployment tax, that's eligible in full. Next slide, please. Okay, so these categories around paid and incurred, the non-cash compensation amount should be reported only as paid during your covered or alternative period. Okay, the revised Schedule A lists non-cash compensation payroll costs as total amounts paid or incurred for employee health insurance, employee retirement plans, and the employer state and local taxes. Okay. The revised instructions to the new 3508, they only talk about paid. It doesn't say paid or incurred. The EZ form says paid, does not say paid or incurred. So it is unclear what the SBA means when they say paid or incurred on the 3508. Next slide, please. So this is just a picture of the new Schedule A and how the form is going to work. Starting with the cash comp that David talked about. Then you're going to have your reduction worksheets that come from the tables. And then you have the non-cash portion of payroll costs, which are the benefits down below line 6, 7, 8. Then compensation for owners is calculated completely separately on line 9 because they have their own limitations. And then you're going to have your total payroll costs on line 10. Next slide, please. So now let's talk about the non-payroll costs that are payments made during the covered period for the business mortgage interest payments, for obligations on real or personal property that existed before February 15th. You may not prepay interest, and no principal payments are eligible. We get that question a lot. It is just the interest portion on these obligations that existed and that you paid during the period, but you cannot prepay. Business rent, lease payments, again, the lease agreements had to have been enforced before February 15th. You have to have paid them. As far as rent, if you normally get billed for your rent on the first of the month and you pay it, and even though that covers a whole month and maybe your covered period ends before the end of that month, that rent is still good. You paid it during the period and it was incurred during the period. Same thing for business utility payments, electricity, gas, water, transportation, which we still don't know what transportation means, telephone, internet access, all again had to have been in service before February 15th. They did not call out oil. If you notice, oil isn't above, but certainly if you heat your facilities with oil, one would think that's a utility, but it's just not listed. So very unusual. But if you don't use natural gas, if you use oil, I would imagine you should qualify as a business utility payment, but it's just not listed. And again, further guidance is required on transportation. The only place we've seen transportation come up is when talking about a self-employed individual that works out of their automobile. It talks about gasoline for their automobile being eligible. But they have not said anything about that related to a non-self-employed business. Certainly some very large companies that got PPP loans may have very significant transportation expenses. Those do not seem to be utilities. But we're just not clear. There's no guidance on what they meant by transportation. Next slide, please. Here. So let's talk about the paid and incurred, right? So rent, mortgage, interest, utilities has to be paid during the period or incurred during the period and paid on or before the next regular billing date. So if you are billed after the end of your cover period for your electricity, that the electricity was incurred during the covered period, that would be eligible, assuming you pay it in normal course on the next regular date that you would normally pay that bill. Borrowers cannot apply the alternative payroll covered period to these costs. So that has nothing to do with non-payroll costs. If you elected the alternative period for your payroll, it doesn't matter. You're using the covered period for these costs to make it even more confusing. Non-payroll costs cannot exceed 40% of the total forgiveness amount in order to be eligible for full loan forgiveness. Okay, we get a lot of questions from people saying, I don't need anywhere near 40%. I have payroll that's 100%. So can I just ignore these costs altogether and just put my payroll? I don't see why you couldn't do that. The only reason we've thought about this question saying, is there a disadvantage to taking more than 60% of payroll? Let's say you had spent 100% of your loan on payroll costs that qualify, but you also spend 40% on these things. How should you fill out your application? Obviously, the application is going to cap you at 100% of your loan no matter what. So you're not, no, you don't qualify for 140% forgiveness. Sorry, there's no such thing. You'll be capped. But one example we thought of was if you're a company that takes certain tax credits that are based on wages, if these expenses do prove to be non-deductible because they were covered by tax-exempt loan forgiveness, that could impact certain benefits you get from paying wages, because if the wages become non-deductible, you might lose related credits. We don't know. I mean, there's nothing on this yet. We're just speculating, but it's just advice we're sharing, that it still may behoove you to go 60-40 to preserve a payroll deduction if you do take tax credits that are based on payroll. So we just wanted to mention that as well. I think Anthony is now going to walk you through the incredible amount of permutations related to the FTE test. We have a lot of questions submitted already about FTEs, so hopefully these next 5 or 6 slides will answer most of those.
Okay, thanks, Greg. So we'll talk about FTEs. Now, the loan forgiveness calculation does include a calculation for an FTE reduction quotient if you had a decrease in your workforce during your 24 or 8-week period compared to the chosen reference period, which I'll explain in a moment. There are some FTE reduction safe harbors that would exempt the borrower from the reduction. And just keep in mind that Form 3508 requires you to go through the calculations and provides supporting documentation of your FTE calculations. Whereas if you qualify to file the EZ application, there is no FTE calculation for that form, but you do have to submit documentation of your FTEs at January 1, as well as at the end of the covered period, to demonstrate that there was no reduction in FTEs. Next slide. So for the long form application, your FTEs will be calculated for either the covered period or the alternative covered period. Now, you have to be consistent. So if whichever period you're using and calculating FTEs for, you have to do it the same way regardless of the period. So you have for each employee the average number of hours paid divided by 40, rounded to the nearest tenth, gives you your FTEs. If an employee works more than 40 hours, they're still capped at 1 FTE. So employees who are working a lot of overtime still only count as 1 FTE. Whereas an employee that works less than 40 hours a week, you'd round them to the nearest tenth, and they could be anywhere from 0.1 to 0.9. Now, the SBA does permit you to elect a simplified method to use 0.5 FTE for any employee that works fewer than 40 hours per week. So it makes it a little bit easier. And this is where I was saying, make sure if you use this simplified method, make sure you use it for every period under which you have to calculate your FTEs. So now I was talking to Dave about this earlier today, and we thought, this is something worth looking at. You may, if you have a lot of employees who are more than 0.5, less than 1 FTE, for example, let's say I had a lot of employees who were 0.9, and I reduced their hours during the covered period, and they went from 0.9 to 0.6. If I use the regular method, I'm going to have a reduction in my FTEs. If I use the simplified method, the 0.9 and the 0.6 will both be assigned 0.5, and it would not reflect any reduction in FTE. So just something to consider when you're going through this. Next slide, please. The FTE reduction quotient is based on dividing each employee's average weekly FTEs during your 24 or 8-week period by a chosen reference period. And your reference period can be February 15, 2019 through June 30, 2019, or January 1 through February 29 of 2020. So you compare how, if you had a reduction in FTEs and you have to calculate the reduction, you're comparing the FTEs for your covered period to the FTEs in one of these chosen reference period. Seasonal employers have a choice of selecting any consecutive 12-week period between May 1, 2019 and September 15, 2019 if they choose. As long as your result when you do this calculation is 1 or greater, there's not going to be any adjustment in your loan forgiveness, because that indicates that you had the same or more FTEs during the covered period than you had during the chosen reference period. Next slide. Now, an FTE reduction, there are certain exemptions from this, from the reduction in forgiveness. In the following situations would not reduce your loan forgiveness if you could not hire a new employee. If you had a position where you made a good faith written offer, key is written offer, to rehire an individual who was laid off at some point after February 15th, and you know they refused the offer, or you were unable to hire a similarly qualified employee on or before 12/31 or the date you file your forgiveness application, you would not calculate a reduction in FTE in that scenario. If you made a good faith written offer to restore reductions in hours and that offer was rejected, for example, you cut someone from 40 hours to 30 hours, and then at some point you offer to bring them back to 40 hours and they say, no, I still only want to continue to work my 30 hours. Just document that. You'll need that documentation for your application. You would not be penalized for that reduction in FTE. You're also not going to be penalized if you had a reduction in FTE because you fired an employee for cause, or if an employee voluntarily resigns or requests a reduction in their hours. You would not be penalized in those scenarios. So if one of those scenarios are met, when you're calculating your FTEs, you want to include that person, that individual employee, in both the covered or the alternative period, as well as in the chosen reference period, as if they never left. Next slide, please. The borrower is also exempt from a reduction in forgiveness for reduction in FTEs if you're able to document that you were unable to operate between February 15 and the end of the covered period at the same level of business activity because of compliance with requirements, with government requirements that were issued between March 1 and December 31 of this year. It's important, again, to, I think David mentioned earlier, or Greg may have mentioned, that you're looking at the state guidance, state and local guidance that's being issued. And so that means if you're located if you have a number of different locations, you're going to have to document this for each locality, each state that you're in, because it could have different impact depending on which location you're looking at. Next slide, please. You're exempt from the reduction in loan forgiveness if you reduced your FTEs between February 15 and April 26 of this year, and you restore those FTE levels no later than December 31 or the earlier of the date the loan forgiveness application is filed. So the day you file, if you've restored any reduction in FTEs to the same level that you had on February 15, you know you're exempt from a reduction in loan forgiveness. That goes to the issue of, let's say I spend all my loan proceeds in 15 weeks, but I've got a 24-week covered period. but I haven't quite restored all of my FTEs yet. And I think I have the ability to restore them given a little more time. So do I wait, till the end of the covered period or sometime after, I've spent all the proceeds to get to the point where I've restored my FTE levels before I file that application? And so that's something else to think about. I also want to mention, because I think before I jump to the next calculation, one of the issues that has been addressed is, what if I have a reduction in FTEs and a reduction in salaries of individuals earning under 100,000, and I reduce those salaries by more than 25%? Technically, I have a loan forgiveness reduction for the reduction in salary. The guidance that was issued clearly indicates that you do not get penalized or take two reductions if your reduction in salary is the result of a reduction in FTE. You would not be penalized twice. You would not take two reductions. For example, if I cut someone's hours by let's say by 30%, and correspondingly cut their compensation by 30%, I don't calculate a reduction in forgiveness twice for the reduction in wage and the reduction in FTE. I only calculate it for the reduction in FTE because that salary reduction is caused by the reduction in FTE. Next slide, please. Now, if I keep people at the same level of FTE and I reduce their salary by more than 25%, and they earn less than $100,000 or did not earn more than $100,000 annualized for any period in 2019, then I do have to calculate a reduction in my loan forgiveness. Now, this chart basically lays out the steps that are in the instructions. I'm not going to go through this step by step, but basically you want to look and keep in mind that it treats salaried employees and hourly employees slightly differently. So the hourly employee, you have to look at whether or not you've reduced their hours and then determine what the value of that reduction in hours is. But basically you're looking at whether you've reduced their salary during the covered period, compared to the period January 1 through March 31, 2020. Don't confuse this with the period that you use for FTEs, the reference period that you can use of January through February 29, 2020. This calculation takes the entire first quarter of 2020 and compares it to the salary or hourly wage that was paid during the covered period. In doing this calculation, the reduction in loan forgiveness is only for the amount in excess of a 25% reduction. So for example, if I've reduced someone by 30%, my reduction in loan forgiveness is based on that 5% amount, not the entire 30%. In the interest of time, to save some time for questions, I'm going to turn this over to David now.
Thanks, Anthony. So I know we have about maybe 12 minutes before we want to get to questions. So we have about 20 slides. I'm going to skip over some pretty quickly, and others I'll focus on that I know that are important. For those who would prefer to watch Netflix after this webinar and watch your favorite show, I highly recommend, if you have not looked at already, at the different forms and instructions for Form 3508. They're now separated out into two different PDFs. There's a connection for the 3508. There's a connection for the instructions to the 3508 on the slide. Go to the next slide, please. And we have Form 3508EZ, few less pages, providing the links for both the form and separate instructions are here. Next slide, please. So the 3508, I'm going to go through this pretty quickly. You basically have your lead schedule. We'll show you that in a few minutes. There's a borrower certification, which anyone who's the authorized representative of the company should pay careful attention to. We will also be showing those in a few slides. There's PPP Schedule A, which Greg talked about earlier, that grabs the different amounts that flow and accumulate payroll costs and FTEs. the PPP Schedule A worksheets, which are basically the detail by employee of their compensation, FTEs, and 25% reduction. There's a separate schedule where the SBA is looking for some demographic information that's optional to fill out. And then there's a separate 7-page instructions. Now, the instructions are very helpful, but there are nuances and specific details within and throughout the 20 or so interim final rules that are also relevant and should be considered when addressing all these different questions that are coming up. Next slide, please. The EZ has just a 1-page lead schedule. There are no backup schedules. For those who are trying to figure out how to accumulate their costs, but they meet the rules for filing a 3508EZ, I do suggest looking at the 3508 regular forms because those can be helpful in just how to organize your different data, whether it's accumulating the payroll costs on an employee by employee level or your utilities or whatever other costs you're trying to accumulate. You don't need to file those forms, but they may be useful in just helping you organize your amounts. Next slide, please. All right, this is a critical form I think a number of people are interested in, and there are some nuances here and some things that may not be 100% clear. If you want to file the 3508EZ, if you're a self-employed individual, sole proprietor, and you have no employees, that's easy. You check the top box and you're done and you can file the EZ. The next 2 boxes aren't as straightforward. So we're looking at the second box, which has 2 paragraphs. The first paragraph for both the second and third box are exactly the same. And in that, you are basically representing that there were no reductions greater than 25% for any employee that made $100,000 or less during 2019. If you can meet that, great. And then you also have to meet the next one. Now, all of these calculations for the EZ, whether it's proving the 25% or the FTE calculations, you don't have to submit them, but you do need to go through the process of calculating it. You need to hold on to that information, which we'll get into in the next few slides about document retention. But just bear in mind, it's not a free pass. Oh, I know I don't reduce anyone's salary, or I know I didn't reduce my FTEs. You still need to prove it and hold on to that. You just don't have to submit it, at least for now, unless you're asked for it later. So back to the second square and the second paragraph. The borrower did not reduce the number of employees or the average paid hours, in other words, FTEs, between January 1, 2020 and the end of the covered period. And there are reductions that you can ignore, which we'll get to in a second. There have been questions, does that mean throughout the period? Or do I just look at my, in shorthand, FTEs at January 1 and compare that to the last day of the covered period? It's our opinion, and we've discussed this internally, that you need to look at every pay period. And if you've had any reductions of FTEs, but for the exceptions that are listed after that, you can't file the EZ. So if you just happen to let people go, but you don't meet any of the exceptions, you can't file the EZ form. The exceptions are, you can ignore the reductions that arose from inability to rehire individuals who were employees on February 15th, 2020, if the borrower was unable to hire a similarly qualified person on or before December 31 or the end of your covered period. So if someone leaves, whether you fire them or they live on their own, for cause or not, if you don't rehire them or make an attempt, you can't file the EZ. You can also ignore reductions in employees' hours where they were offered to restore them, but the employer refused. And the third box, we talked about the 25% rule, which is in the first paragraph. In the second paragraph, we've gone into some depth about, and that is if basically the government forces your business to, as a result of their actions, your business loses activity, through whether that's a drop in revenue, or likely that's a drop in revenue, so you can't afford to pay your employees, and you can prove that, then you also can file the EZ, even though you have a drop in FTEs. Next slide, please. This is just a summary of what the calculation is about. The calculation on 3508 and 3508EZ is basically the same. After you add up all your costs, and on 3508, take whatever reductions you have for FTE quotients for the 25% reduction, that results in your modified total. You compare that to your total loan, and you compare that to your payroll cost grossed up by dividing it by 60%. Whichever of those three numbers is the lowest is your forgiveness. Next slide, please. The only difference with the EZ form is that to get to your total cost, you don't have any FTE reductions and you don't have any reductions for the 25%. You still compare your total payroll and non-payroll costs, the sum of those, to your loan and to your payroll cost divided by 60%, whatever number is the lowest, is your forgiveness. Next slide. So this is just an eyeball view of the form, page 1 of form 3508. You're adding your payroll costs, your mortgage, rent, utilities. You then back out your FTE reduction by multiplying the quotient times those amounts. Built into that are also your salary and hourly wage reductions if you don't meet the FTE or the other safe harbors. I do want to point out one thing. So there are 2 safe harbors for the FTEs. If you meet those safe harbors, you have no reduction to calculate on this form, which is a little bit different than the FTE exceptions. Those exceptions are an employee by employee basis. So each employee you have to calculate FTEs. You might have an exception for a specific employee, which is different than the safe harbor, which is if you meet the safe harbor, it's across the board. I just want to make that distinction. And then we already talked about how you calculate the forgiveness by comparing the 3 amounts. Next slide, please. So this is what the EZ form looks like. Same thing, you're just not deducting anything for FTEs or salary reductions. Line 5, 6, and 7, you compare those 3 amounts, take the lowest amount. This is on the 1 page of the EZ form that you have to file. And when I say 1 page, there is also a separate certification that you have to fill out, which we'll get to in a minute. Next slide, please. Okay, I know this is a little bit hard to see. Given the time we're at, I'm going to just suggest whoever is the authorized representative and signer, read these carefully. There are potential legal, criminal actions the government can bring if things are falsely presented knowingly. There are some minor differences between the 3508 and the EZ certification, and that's primarily because of the differences in how it's calculated. That is the FTE reductions and the 25% rule. At the end of the day, the certifications are pretty similar. Go to the next slide, please. The EZ at the bottom, the certification has to do with the checklist that we talked about earlier, whether you meet the standards or requirements of the EZ. And if you read those carefully after this presentation, you'll see how they tie in directly to those requirements to file the EZ form. Next slide, please. All right, this is just a brief top-level 30,000-foot overview of what is involved. I do want to point out on step 2 and 3, where on the Form 3508, you are calculating FTEs and you are calculating salary wage reductions, and we noted not done on EZ. It's not done on the EZ that you're filing, but you still have to go through the process of these calculations and hold on to those and maintain those for 6 years to prove that you didn't have reductions in FTEs or 25% reductions. But these steps pretty much follow the slides, the forms themselves, so I'm not going to repeat them. And I'll pass it along. Thank you.
Thank you, David. Yeah, time's getting short. So we're going to go through this real quick. There's so many questions. I want to get to a bunch of them because there's a lot of repeating themes. So this is a list of the documents that you'll have to submit with your application. Obviously, in addition to the forms, we have a list here for you. You also must retain these documents for 6 years after the date the loan is forgiven or repaid in full. Okay, next slide, please. So this is the documentation required to support the payroll that you're going to list. It includes bank account statements, payroll service provider reports, tax reports such as 941s, payment receipts and statements relating to your other payroll costs, your health insurance, your retirement plan contributions, etc. Next slide, please. For the non-payroll costs, These are the documentation requirements for the debt payments, amortization schedules, account statements. For rent, they want a copy of the lease agreement and the canceled checks or the statements from the lessor. Utilities, they want the invoices and they want the canceled checks or statements that verified the payments were made or received on the other side. Next slide. And related to FTE, you're going to have to provide documentation, presumably the payroll registers for these periods to support your FTE calculations. Again, depending on which base period you chose, you'll have to support one of those 3 periods. And the documents, again, can include payroll tax filings, the payroll registers, state quarterly wage reports, which are great because they list all the detail as well. Next slide, please. Anthony, I'm going to just breeze right through these because we're out of time, okay?
Sure.
So documentation that you have to maintain but not submit, okay? And there's a few slides on this topic as well. Obviously, support for any of the exemptions you're claiming around terminations for cause, around resignations, around refusals of offers for employment, for reemployment, all these kinds of things that support your exemption. You don't have to submit, but you have to maintain in case they ask for it. Next slide. Okay. Documentation that supports your certification. Again, we've talked about that many times at our webinars, that it was good practice to document how you met the certification requirements on your PPP loan application. Same thing here, documenting how you met the requirements under the PPP forgiveness application. And then the documentation that supports the worksheets, again, for the safe harbor too. Next slide. And then anything around the salary reduction as well must be maintained by employee. You can see we have put in bold, the payroll report documentation must list each employee. And of course, the documentation regarding the job offers and refusals, inability, attempts to hire and inability to hire, etc. All needs to be maintained. Next slide. It's a lot of documentation. More documentation around hours and number of employees for 2020. So you have to maintain your payroll records, which you would do anyway, obviously. And documentation supporting your certification if you are unable to operate at the same level of activity. Okay, so these include copies of requirements based on borrower's location and your financial records. There's a bunch of questions I saw submitted around this topic saying, I'm allowed to open, but my primary customer base has not been allowed to open. So I'm still not able to hire anywhere near the amount of people I need. So this could be, I guess, a distributor that sells, let's say, to restaurants that still can't open. The distributor, though, is allowed to open if they're deemed an essential business. Are they allowed to take this exception that they were unable to operate at their pre-levels because of these restrictions and this guidance and this regulation? We don't know the answer to that question. It's a great question. I would speak to your attorneys about that question if you're going to claim that exemption, to interpret the regulation to see if it would apply in those cases. I mean, on its face in the SBA rules, there's absolutely nothing about you couldn't return your business because your customers went out of business or your customers couldn't open. There's nothing in the SBA guidance about that. But that is a very common question I saw submitted today. Next slide. And lastly, the loan review procedures. The caveat is the SBA may review any PPP loan at any time, presumably for up to 6 years, because that's the requirement to maintain documents. Lenders are going to have 60 days to give a decision on your application for forgiveness. They're going to give that decision to the SBA, not to you. The SBA will then have 90 days to review that and to remit the money to the lender that they've approved as forgiven. Okay, the lender must notify the borrower in writing that the lender issued a decision to the SBA denying the application. So if your lender says you don't qualify for forgiveness and they tell the SBA that, they're required to tell you that at that time as well. You will then have 30 days to request a review of that lender decision. Okay, this is not an SBA decision. This is if your lender says you don't qualify for forgiveness. You can appeal that to the SBA. Okay. We do not yet have any process that's been shared with us, with anybody from the SBA, that what if a lender approves your forgiveness, but the SBA overrides and denies it? Will you have an appeal? Is there any appeal process? There's nothing out there that says you can appeal the SBA's determination. Presumably you would be able to, but there's still nothing out on that. And again, nobody is yet accepting applications for forgiveness. And a reminder that any borrower, together with their affiliates, whose total PPP loans were less than $2 million, are at least exempt from any penalties related to the certification. That's the new safe harbor. So even if they determine during review, not only aren't you eligible for forgiveness, you shouldn't have been eligible for a loan, you still have the safe harbor on the $2 million or less.
Greg, just one caveat to that is, so the SBA has said that they would not take any action and they would not refer it to any other agency, but let's keep in mind, we don't know what might happen. So if someone did not make that certification in good faith, and let's say you had a whistleblower, a disgruntled employee who reported it to an agency other than SBA, there's no telling what they may do with it. So hopefully everyone's still making that certification in good faith.
Thank you. All right, let me get to some of the questions, and I'm just going to caveat everything. There's almost 200 questions that have been submitted. A lot of them are super fact specific. We're not going to answer those obviously right now for everybody. They're so specific to your situation. If you want to pursue those with us, please feel free to email those questions to covid19@anchin.com, and we'll do our best to help you. These questions I'm going to focus on here are going to be more broad, that impact more of you, to respect everybody's time. A lot of questions, gentlemen, about the FTE count. People seem still a little bit confused on the restoration requirement. You know, if I apply, let's say I apply after 14 weeks, what's my safe harbor date? Is it the end of that 14 weeks? Is it the end of the 24 weeks? Is it December 31st? There's still a lot of confusion around that. Could we clarify that for people?
Sure. When you do the calculation, if you look at the form, it asks you for your FTE as of the date that you filed the application, basically December 31st, or the date you filed the application, to see where you are at that point. So it is as of the day you file. If you're filing early, if you're filing before the end of the covered period, it's based on the date you're filing, but you do have until December 31st to restore FTEs. So what I would think about is, if I haven't restored all my FTEs yet, and I think I have the ability to, I may just want to wait a little bit longer before I file the application.
Exactly. Now, along the same lines on FTE, if you're claiming one of the exemptions on the FTE for whichever one of the exemptions, there are a lot of questions around, well, then do I count them out of all my math when I'm doing the comparison? Or do I include it, show the reduction, but then I have an exemption because the reduction is due to one of these exceptions. Is that how I'm supposed to do it, or is there another way I'm supposed to do this?
I don't think that the instructions are 100% clear. I think it's one of two choices. So let's say you have an employee who had 10 FTEs altogether, and one employee in particular had one FTE, and they left on their own. So it went from 10 to 9. You're not going to take into account that reduction in FTEs. So you either remove it completely from the comparative period, the earlier period, so that it's 9 to 9, or you add it back to your covered period, which would make it 10 to 10.
Okay.
Whichever approach you ultimately take, you're going to end up with no impact as a result of that employee maybe who voluntarily left. The instructions aren't 100% clear as to whether you add it back. I think I would lean towards adding it back as opposed to removing it from the original period, but they're not 100% clear.
Okay, thank you. And then on a lot of questions on the exception for the government restrictions and unable to return to normal business levels. With New York City slowly reopening and the surrounding regions reopening slowly and hopefully it will continue. A lot of questions around, during my 24 weeks, there may be 16 weeks where I was effectively out of business, and now I have 8 weeks that I'm slowly going to come back into business. How do I apply this exception?
It's a great question.
Good question.
It is a great question. I
So-
thought it was.
Yeah. In typical fashion, part of it may be an effort to get these instructions out as quickly as possible, or just not having the ability to consider every permutation and combination that could exist. They don't specifically address that. On its face, it would seem if you're impacted in any way, even if it's partial period, as a result of New York City or whatever locality's guidelines, that you would meet that safe harbor. Whether the SBA comes out with further specific guidance on that issue, that you have to deal with a partial period opening, I don't know. As it stands right now, I would take it on its face and say you would meet it, even if it's just a partial period at this point.
Okay.
Yeah.
Let's pivot towards non-payroll costs for a second. A lot of questions still around paid and incurred. A lot people got their loans mid-April, late April. We have questions both ways. I paid April's rent right before I got my loan. Can I take a piece of that? Or, and that clearly I think is no, it wasn't paid during the covered period.
I agree with that. Yep.
And the opposite, I hadn't paid April's rent. I got my money. I could now afford to pay April's rent, so I paid it in late April. Can I get the whole month's rent or just the post-loan period?
One of the IFRS interim final rules explicitly addresses that issue, and they give the benefit of the full payment for the non-payroll costs. And they go on to explain the fact that initially it was going to be limited to 75, but now it's limited to 60%. They're not fearful that it'll be taken advantage of. I've seen questions where is it 75 for the 8 weeks and 60 for the 24? There's no more 75% rule. It's 60% across the board, no matter what period of time you apply for the covered period.
Yeah. And a lot of questions people had about their leases, which really might be more legal questions. What if my lease expired during my covered period and I just continued to pay month to month? What if I've always been on month to month? Is that a lease? Is that qualify as a lease? What if I restructured? What if I gave back some space? Does that mean all my rent is no longer eligible? A lot of these kinds of questions around contractual obligation having to have been in place as of February 15th.
To that point, if they were in place as of February 15th and you have a lease in place, a written lease, I think even if you restructure it during the covered period or went month to month, there was probably some sort of communication either with the landlord that you want to continue month to month or the restructuring agreement itself that continued the lease. I think you're okay as long as the continuation of that original, that you were in that facility as of February 15th. There was one question though, if you never had a written lease at all and you just always had a verbal agreement, as best you can, so whether it's through proof of payment that you've had in place for whatever period of time or any communication with the person or company that you're paying the lease, I would use that as support for that, the fact that there was a lease agreement in place.
Yeah.
Do the best you can to support it in every way you can.
Yeah, that's a question that I had been asked too. And yeah, I think if you can show the history of making those payments prior to February 15th to demonstrate that it was the arrangement was in place at that time, that you should be okay, but just make sure you have enough documentation.
Okay. I think the last item I wanted to cover was related to the payroll costs that are not wages, the non-cash payroll costs, the health insurance and whatnot. A lot of people, I guess, it's not really questions. They're outraged that they were allowed to include the health benefits when they got their loan amount, and now they can't include the health benefits on the owners for forgiveness. They don't seem to think that's fair. So we appreciate the commentary and for not using any curse words in that. We thank you for that.
Yeah, I mean, look, the hope is that with the 24 weeks, you borrowed based on 10 weeks. The hope is that with 24 weeks, that your payroll costs, so your cash payroll costs alone,
Right,
would be really put you in a good position for forgiveness.
So that leads me really, I guess, let's say this is the final question, which is implied in a lot of people's things. They're still confused about when they should apply for forgiveness. A lot of people are saying they don't need 24 weeks, to your point, Anthony. They don't even need that long. But they still seem confused. So do I have to wait should I still wait 24 weeks? Why would I apply early? Why wouldn't I apply early? I mean, the question's been asked both ways. I mean, what's our take on the merits of when you should apply for forgiveness?
Anthony, you want that one or should I take it?
Sure, I'll take it. And then you can correct me. My take is, as soon as you feel that you're eligible and your lender is accepting the application clearly, I don't think it hurts. There are certain situations where you may want to try to get this, if possible, closed out before the end of the year. Just because I know certain borrowers that I've spoken with want to understand what it looks like for their tax return at the end of the year, or what it's going to look like for financial reporting at year end. So they may want to have that certainty. So if they can get it before the end of the year, great. But also think about if you have any items in your application that are sort of unclear, uncertain, maybe you want to extend to that full 24-week period to make sure you have enough costs in there that are black and white and that are not gray. And so maybe you want to extend that period to the full 24 weeks to make sure you have that and can get 100% forgiveness without any of these gray areas that we've talked about.
Just to add on to that, if at week 12 you're more than comfortable of meeting the full spend on the loans and you're going to get 100% loan forgiveness, you have no issues with FTEs, but then you look down, where do you know you're going to be for 12 weeks from then, from an FTE perspective? And if you're going to have to cut your workforce and you're going to then get hurt by the reduction in FTEs, it would have made sense to file earlier, assuming you were at the 100%. If you don't file at all after the end of your covered period, you have 10 months. And after the 10-month period, it becomes a loan. So don't forget to file the application. If 10 months pass after the last day of the covered period, whatever that covered period is, and you don't file, you're going to get converted to a loan regardless. Then your time is up.
Yeah. And I think to Anthony's point about wanting some certainty for whatever reason, doesn't have to be related to a tax return or financial statement. Sometimes you just want some certainty. Particularly if you have a larger loan, the larger your loan, probably the more likely the lender is going to take more of the 60 days they have, and the SBA is going to take more of the 90 days they have. from the time you apply. So the longer you wait to apply, you could, remember, you're tacking on 150 days potentially to wait for your final decision. So think about that in terms of your calendar and where the business decisions you want to make related to the certainty or lack of certainty you might have in qualifying for forgiveness. Well, I want to thank everybody again for joining us this morning. Thank you for submitting so many great questions and your patience, and hopefully the technology and the presentation was easy to follow. I think, as Ashley said in the opening, the presentation will be shared post, so you'll have access to all this information. And please, any further questions, do not hesitate to reach out to us at covid19@anchin.com. And have a wonderful day and stay safe.
Thank you.